Good morning, everybody. Today we are going to start our chapter 5, that is accounting standards. As you people did the basic accounting terms, the basic fundamentals of accounting, you also come to know that the American approach is there, English approach is there. The basis of accounting you have done, how it is to be done. There are basic certain rules. There are certain rules, norms are there by which or by applying or considering all those rules and norms, the accounting is to be done. Those norms are known as the accounting standard that you come to know in detail in chapter number 5 today. See, what are the learning objectives? Means after studying this chapter, what should be you able to understand? It's your need of accounting standard, nature of accounting standard, use and utility and benefits of accounting standard, limitations of accounting standard, characteristics of IND stands for Indian accounting standard. Two type of accounting standards are there. One is Indian, that is applicable in India only, and one is international, that is IAS, International Accounting Standard. And objectives of Indian accounting standard and merits of Indian accounting standards. Let's start with the need. Before look at the content that what the author has said, I just want to tell you, see, in the beginning when the accounting started, there are some generally accepted accounting principles, means GAAP. GAAP is a very famous abbreviation. You ever listen, GAAP, generally accepted accounting principle. In the beginning, whatever the accounts are to be prepared by any of the enterprises that are to be prepared while considering the GAAP. But it don't develop as much reliability or the uniformity in the books of account. Uniformity, we can say, comparability will not be developed. Why? Because in GAAP, there are various alternate methods have been given to prepare those accounts. So in case of the various alternate method, what happened? Many times different enterprises just use the different methods. In that case, it will not become the uniform account and comparability will not be possible for the analysis. Moreover, if you apply the one method in the 1 year and apply the another one in the next year and then another one in the next year, then also comparability will not be developed. And when there is no uniformity, when there is no comparability, and we are using the different methods every year, it will not give a true and fair position as well. So in this way, in order to remove all these weak points or the limitation, and a committee is developed and that committee has given certain rules, norms, laws to prepare the accounts, and those norms are known as the accounting standard. Let's see what the author has given over here. Accounting is an information system and its main aim to provide the financial information to a number of parties. Yes, no doubt, there are so many parties who are interested in the business or enterprises accounting. These are the internal user as well as the external user, like the investors, management, creditors, government, etc. Such information is provided through a set of financial statements, namely profit and loss account and balance sheet. So as per the section 129 of the Company Act 2013, the financial statements of an enterprise should depict a true and fair view of its operating results and financial position as well. However, what the constitutes true and fair view has not been defined. This view is not been defined by the Company Act 2013 or in any other state. Over the period of time, a number of generally accepted accounting principles, means GAAP, in the form of concept and convention have been developed and accepted to bring the comparability and uniformity in the financial statements of various business entities. But the difficulty is that GAAP also allow a large number of alternative treatment for the same item. The different enterprises may adopt different accounting policies for the same transaction, or an enterprises may follow the different accounting policy for the same item over a different accounting period. I hope it is clear to you that the different enterprises may adopt the different method, or the same enterprises sometimes adopt the different method for the different period as well. I also explained you in the beginning as well. As a result, the financial statement become inconsistent and uncomparable. Comparability will not be developed at all when the different methods are to be used. Hence, there is an urgent need to harmonize and standardize these diverse accounting policy. So in order to harmonize and standardize these policies, the standards must be prepared and followed for preparation of financial statement so that there is a minimum possible ambiguity and uncertainty about the figures contained in the financial statement. The International Accounting Standard Committee. Yes, please note it down. A committee has been developed, that is here IASC, that is International Accounting Standard Committee, come into existence on 29 June 1973 to develop the accounting standards. The Institute of existence on 29 June to 1973 to develop the accounting standard. The Institute of Chartered Accountant of India and the Institute of Cost and Work Accountant of India are associated with the member of IASC. The Institute of Chartered Accountant of India also drawing up its own standard, which are basically patterned on the International Accounting Standard and are modified according to the conditions and practices prevailing in India. So this is all about the need of accounting standard. Now let's move to the basic concept of accounting standard in a form of definition. So accounting standard may be defined as written statement issued from time to time by the institutes of accounting professionals and specifying uniform rules and practice for drawing the financial statement. Kohler has defined it also like standards as a code of conduct imposed on accountant by custom, law, professional body. So this is your meaning of accounting standard. Now, what is the nature of accounting standard? As again and again we are telling it is these are the laws, these are the norms. So these are the lay down the norms of accounting policies and practices by a way of code to direct that how the transactions and events should be dealt with in accounts and disclosed in the financial statement. For example, accounting standard may be defined the term of cost and lay down a definite method for valuation of inventories with the minor modifications under special circumstances. In this way, they remove the effect of diverse accounting practices and policies so that the financial statement of different business units become comparable. No doubt when the uniformity is there, when the set of rules are so conserved, in that way, comparability can be developed so easily. They prescribe the preferred accounting treatment also. It don't give you the method only, it also give you that what is the preferred method to do that treatment from available set of methods. They also provide the information to the users of the financial statement as to the basis on which statement have been prepared. These also area within which accountant has to function, and in respect they are just like laws. So this is all about the nature of accounting standard. Now objective. Again and again we are discussing that it developed the comparability, it developed the uniformity. So no doubt it ensured the uniformity for the preparation of financial statement. It also provide the information to the users. It also improved the effects of these accounting policies and practices as well. It ensures the consistency, transparency and comparability of the financial statement. To improve the reliability means the true and fair position on which you can trust, and credibility of the financial position. What is the utility? Utility are all these objectives. It's just the manipulation of the statements, you can say, as we said in the objective, to improve the reliability or the credibility. So what is the utility? Accounting standard improve the reliability and comparability, credibility of the financial statement. As we said, to ensure the consistency, we have to say in importance, accounting standard ensure the consistency and comparability. Whatever you did in your objective, it just manipulated and then it become the utility, importance or the benefits of the accounting standard. Accounting standard help in resolving the conflict of the financial interest among various groups. As you know, so many people, so many parties are interested in the business organization accounting information. So whatever the conflict they have, whatever the confusion they have about the or regarding the business enterprises, it will be completely removed. Accounting standards significantly reduce the chances of the manipulation and frauds as well, because these are the certain fixed norms, like bylaws. These are helpful to auditor. When the auditor check the account, it also helpful to him as well. Now, look at the dark side. It also has some limitations as well. The limitations of accounting standards are, in spite of many benefits derived from the accounting standard, there are some limitations. Number one, restrictive initiative. Because the accounting standards are mandatory in nature, so it restricts the initiative for the better presentation and disclosure. These are very rigid in nature, no doubt, because they restrain the accountants from using a more suitable alternate solution to a particular problem. Based on the historical cost. Accounting standards are based on historical cost concept. Assets are shown in the balance sheet in the historical cost, and such depreciation is also charged on such historical cost. This is the reason that IFRS, means International Financial Reporting Standard, were introduced, wherein assets and liability required to shown at their current and fair values and obstruct the judgment of the auditor. It also, because the standards are mandatory, that are much compulsory, so auditor become abstract in that case. So this is all about, let's recall what we did by the time. We started with the meaning of need of accounting standard, then we did the basic meaning and definition, then we did nature of accounting standard, objective of accounting standard, utility and benefit of accounting standard, and last we did limitation of accounting standard. We are just talking about the basic Indian accounting standard. Now see what is Indian accounting standards. Indian accounting standards are the Indianized version of International Financial Reporting Standard. So now question arises, what is IFRS? It is a set of accounting standard which developed by the International Accounting Standard Board. It is IASB. Please remember these abbreviations as well as the full forms, because these are authenticated, on the basis of which financial statements of enterprises are prepared and presented to the users. What are the features if we talk? IND-AS are the modified version of IFRS. IND-AS are the comprehensive and covered a very wide area comprising the revenue, expenses, losses, assets, liability, as well as equity. IND are the principal based. Under IND-AS, items are shown in the balance sheet as per the principle associated with each item. IND-AS lay emphasis on transparency and accountability of the financial statements. The next is objectives of Indian accounting standard. Objectives are to ensure the uniformity in preparation and presentation of financial statement. Likewise, the accounting standard ensure the uniformity, very similar to that. Indian accounting standard also ensure the uniformity. It also provides the information to the users about the policies adopted for the preparation of financial statement, to remove the effect of the diverse accounting policies and practices, to ensure the consistency, transparency, and comparability of the financial statement, to improve the reliability and credibility of the financial statement. What are the merits of Indian accounting standard? suitable for the Indian condition. They have been framed in such a way that they are the most suitable for the Indian condition. Clear guidelines for financial reporting. Indian accounting standard provide a wide framework in which clear guidance are given for the financial reporting. And under the framework provided by Indian accounting standard, assets, liability, and equity were clearly defined. Moreover, it also provides the uniformity in the financial reporting. It brings uniformity, comparability, and transparency in the financial statements, helpful to investors as well. Investors require high quality, relevant, reliable to make the economic decisions. It also difficult to commit the fraud and manipulate the books of accounts. Now, acceptability, if we see, or what is the applicability of the accounting standard in Indian accounting standard. The procedure to issue the accounting standard is being followed in case of existing accounting standard. These standards are first approved by the Council of Indian Institute of Chartered Accountants, ICAI. Everybody, I think, heard about this name. And then it is sent to the National Advisory Committee on Accounting Standard. Firstly, it is approved by the Council of Indian Institute of Chartered Accountants. The accounting standard that is defined as Indian accounting standard, first of all, it is approved by the Institute of Chartered Accountants. Then it is sent to the National Advisory Committee on the Accounting Standard for their approval. And NACAS recommend these standards to the Ministry of Corporate Affairs, and on their approval, the standards are notified in the official gazette. The Government of India has issued notification regarding 41 Indian standards so far. The Government of India has also clarified that unlisted companies with the net worth under 500 crore and the urban cooperative bank with the net worth under 200 crore won't require to adopt Indian accounting standard. They will continue to apply existing accounting standard. What are the difference between the basic accounting, the journal accounting standard, and Indian accounting standard? Here in the form of difference is given to you. Let's see what is the difference. Basis. Accounting standards are based on international standard, journal accounting standard, while the Indian accounting standards are based on IFRS, means International Financial Reporting Standards. It is based on the rules, long and complex, while the Indian are principle based. They report according to the essence of that transaction. The language used, accounting standards are drafted in technical language, while Indian accounting standards are drafted in simple and clear language. Fair value of asset, accounting standard follow the age-old concept of historical cost. The Indian accounting standard are based on the fair value of fixed assets. Trust and reliance by the international investor. Accounting standards are not treated with trust and reliance by the international investor, while the Indian accounting standards, as it is based on IFRS, so have a high command of trust and reliance by the international investors. And uniformity, accounting standards do not ensure the uniformity in the financial reporting, while the Indian accounting standard ensure the uniformity in the financial reporting. Multiple reporting, accounting standard require the multiple reporting of for the companies in the different countries use one set of financial statement in the home country as well as the other set for the foreign country as well. And this is because they are using the historical cost concept. But on the other hand, the Indian accounting standard ensure that there is a no multiple reporting of to the companies located in the different countries. So in this way, this is the basic difference between the accounting standards and Indian accounting standard. It is all about for the day. We did the complete chapter of accounting standard, and if anybody have any doubt, please ask.